Vanakkam, Namaskar, and hello to all the viewers and listeners of this edition of Fixed Income Market with Sundar Mutual Fund. In this edition, we will be focusing on budget and the upcoming monetary policy. The finance minister unveiled the budget in the parliament, and as a fixed income investor, we were looking at what extent of market borrowings will be there and is the budget math credible. On both the fronts, government came out with flying colors. Not only did the minister contain the market borrowings at rupees 15.4 lakh crores, slightly lower than the market expectation of around 16 lakh crores, but also the budgeted nominal GDP growth at 10.5% seemed reasonable, with tax buoyancy assumed at roughly 1.1 also looked realistic. The fiscal deficit was touted to be at 5.9% out of about 50 basis point consolidation from 6.4% in FY23. With realistic receipts and quality of spend being non-inflationary, as the revenue expenditure has been curtailed while capital expenditure has been increased by over 35%, tilting in favor of higher multiplier spends by the government. Barring any unforeseen events, this bodes well for fiscal consolidation path set out after COVID-19. With the budget turning out to be prudent and non-profligate in a pre-election year, MPs is likely to take this positively and stick with a 25 basis point hike in line with what other central banks are embarking on in the global arena. And a possibly more neutral tone is also expected compared to last time, as we have seen muted price pressures in the interim with declining inflation. The global inflation, although still high, is coming off and is likely to be much lower than the peak created last year. This bodes well for the future inflation trajectory. As a result, we saw Federal Reserve hike by as much as ever by a much smaller 25 basis point in line with what market was expecting. Bank of England by 50 basis point and ECB by 50 basis point again in line with what the market was expecting. But everywhere bond yields softened as the market believed that worst of the price rise is behind us. In India, the credit offtake has been sustaining at mid-teens, and with more capex spends from the government and tax rebates in lower income band can keep the consumption demand high, keeping the demand for money in turn robust. So on the liquidity front, we can expect the normalization to continue, as well as we may find the banks to raise deposit rates further and maybe in longer tenor buckets to attract savings, as the government has launched some new small savings scheme and increased limits for retirees in older small savings scheme. The flatness in the yield curve is still there, and we recommend that investors can look to deploy monies in mid-duration active strategies, as we may see a decline in yields on account of inflation moving down toward the MPC target of 4%, but should be more statistical in nature, and any negative outcome on the monsoon trajectory can result in seasonal spike in vegetable prices. Conservative investors are best advised to put monies in roll down maturity products where the inherent duration risk reduces with each passing day. Thanks for joining us in this episode. Looking forward to see you in the next episode.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.